Capitalmind PMS. Hi Krishna, very good afternoon. Thank you so much for joining us today. We're just about 7 points away from that 26,000 mark yet again. And nonetheless, stellar moves coming in, nearly 200 points of gains on the Nifty. Just wanted to understand, after last week of, some bit of profit booking that we saw, today, after this, do you think a sustained rally is what we are going to see? And if so, what will be the key drivers going forward?
Hi, good afternoon. Thank you for having me. So after almost a year of consolidation, Nifty is close to an all-time high. And this time, actually, it looks like it is backed by earnings visibility, not only just for Q2, but we expect this visibility to continue for Q3 as well. So this is on the back of the last 6 months, we had seen a push of reforms in terms of liquidity, tax cuts, GST, etc. So we believe this particular rally is not just on the P expansion or on hope, but actually backed by earnings, which are in fact encouraging as well. Having said that, till now, whatever you see, it's almost only large caps participating in the rally. So year to date, Nifty 50 is up 9%. However, midcap index is up 4% and small cap index is down -3%. However, we believe as the results is in progress and earnings remain encouraging, which they are, by the way. So we expect this rally to be broad-based and not just limited to few names or few sectors in the large cap.
That's right. Krishna, having said so, as we clearly see that the earnings season has panned out and the start had been well. With the IT majors coming up with good set of numbers, yes, FMCG still a bit of a concern, but at the same time we are eyeing the banks and financials, and moving ahead we'll have the telecom as well as pharma companies also. How do you see the earnings season, and considering the same, what are the sectors on your focus radar?
The early signs, as we have seen, financialization, you take financials, NBFCs, large banks, they are delivering very good numbers. In fact, AMCs are also delivering very good numbers. So that's the early sign, and we have been positioned ourselves in financials. The entire financialization themes, bank, financials, AMCs, brokers, etc. And on top of that, we also have consumption themes, premium consumptions. It can be passenger vehicles, it can be not the staples, not the FMCG part, but premium consumptions. They are also showing some early signs in terms of hotel bookings or in terms of high-end cars, SUV bookings, etc. That is encouraging. And capital goods, infrastructure, defense names are also having some good order book or showing some good earnings visibility. So broadly, we are positioned ourselves in these names, in these sectors.
Understood. So that's the sectoral view. But Krishna, talking about India, we have underperformed the rest of the global markets this year. But now that the momentum is gradually picking up, there's some sustained rally, some sustained growth coming in, and the outlook is also pretty good for the coming quarters. Just wanted to understand, where do you see India is placed right now, especially in the emerging market space?
So we are already seeing that early signs. The FIIs consistent selling from July till September. We had seen kind of a reversal. In October, they have bought around 6,500 in cash markets, and the early trade, let's say sell India, buy China, which started 1.5 years back, has already played out. One thing, the earnings are coming back. Second, the valuations are much better in shape for a growth. The growth India is providing on broader emerging market basis. And third, we are looking for some mean reversion because valuations comfort is there, and the earnings visibility is coming. So broadly, I think it's just a matter of time when FIs will come back. Till now, whatever happened, the market has been sustained because of SIP flows. Once FIs start to come back, they already stopped selling. But once they start to come back and buy, we may see. That's why we can expect this rally to kind of sustain in the near term as well.
Okay, Krishna, talking about the sectors and also the texture of the market, at the same time, if we talk about the positive triggers coming from the global markets and also the FIs, DIs positioning, while the DIs were constantly supporting the domestic markets, the FIs comeback is what we all were hoping for. Now that we see good 4 to 5 sessions of buying coming in from FIs, do you still think it's quite early to say that the FIs have made a comeback, or you see the FIs, foreign institutional investors, seeing some good momentum in the domestic market now?
So too early to say that they are making a comeback immediately, because so broadly what happened is, because of the lag effect of GST reforms coming in, market has moved ahead from Q2, and it's already started focusing on Q3 numbers, be it in terms of management commentary or sentiment, or the sales growth we are seeing in Diwali and broader consumption place as well. So FIs are still focusing on that. A good thing is they stopped buying, but they are also waiting for the earnings to kick in. So when I say earnings to kick in, right now let's put the numbers. Nifty 50 median PAT growth, even only 20 names have come up, is hardly 5%, and PAT is technically flat. Medium PAT is actually flat, 1%, 1.1% growth year on year. So these are not very stupendous numbers to see. The idea is that, okay, everyone, market has discounted Q2, moved ahead to Q3, and the idea is that this momentum will come in Q3 as well. And I think FIs are also in that wait and watch mode to see how this pans out.
Understood. So Krishna, now shifting focus to valuations also. Then you was just highlighting that defense sector has a relatively good earnings visibility on the back of robust order books that most of the players have. Just wanted to understand, do valuations look reasonable now for the defense sector, and also if you could shed some light on the new age tech sector?
So first on defense, the valuations are still stretched, because whatever the valuation P expansion has to happened on order book visibility. But there are few names where because the earnings are lumpy in this particular sector, in the last 1.5 year, even though the order books are like 4x, 5x of their sales, the valuations haven't been sustainable because they are lumpy in nature. However, there are few pockets, again, we own BEL, it's not a recommendation, please note, where the valuations are still okay, and the visibility is much better than compared to any other PSU or private players. So again, you have to be choosy when I say defense. Still, many of the mid and PSUs are trading at 50, 60, 70 valuations, which are not comfortable. You have to be a little more picky and choosy in these names. Coming to new age tech platform names, they are delivering consistently. We have seen Zomato delivering great set of numbers. We don't own, but yeah, I think that kind of growth, be it 50, 60, 70% top line, may not sustain for the next 5 to 10 years. I mean, at least 5, 7, 10 years, but they are growing at, if you see Nifty earnings, the largest revenue growth is by Eternal. So I think broadly on broad basis, Nifty 50, Eternal and new age platform tech companies will continue to the high growth. You can give it 30, 35, 40% CAGR, at least for the next 2 to 3 years, is what we own. But again, the entry has to be very, the valuations right now doesn't justify a new entry on these names.
Agreed. Krishna, we hear you when you say you're bullish on sectors like financials, autos, capital goods, consumption, hospitals. But are there any sectors which you are staying away from, and something that you would want to advise our market viewers and participants as well? And along with the same, any top holdings or stock specific, maybe any ideas which you would want to give, if at all?
So one sector which we haven't, which we are still not so bullish, or just being not fully allocated, is IT, large cap IT. Small cap IT or mid cap IT have created their own niche, and they are kind of delivering. We have seen numbers of Coforge and not recommendation, we don't own them as well, but they have created their own niche. But large cap IT, the service based IT, is still yet to get back to their growth numbers. And of course, it has corrected. The valuations look reasonable in terms of last 3 to 4, 5 years median average. However, the 2020 to 2023 growth numbers these IT players have delivered, they are kind of one-off. We can't give them the previous valuations. So even though the valuations are corrected and looks interesting. We haven't started buying yet. We will be still in a wait and watch mode for large cap ITs. And other sectors which we kind of continue to be bullish on is capital goods, infrastructure plays. There are very good small mid cap names which are looking interesting, and valuations are still reasonable. So one company which is one of our top holdings is Pennar Industries. Not a recommendation, please. So we continue to hold them from past 2 to 3 years. They are still available at mid 20s, delivering 18-20% growth, and they are into pre-engineering fabrication. And so if you try to identify those names, so again, when I say mid cap are looking good, at least the starting, because among Nifty 50, mid cap and small caps till date in Q2, the fastest growth we are seeing in mid cap. Mid caps have delivered median sales growth of 12% and median PAT growth of around 13%, vis-a-vis Nifty, as we discussed, 5% and 1%, small cap at 7% and flat. So mid caps, you are seeing that growth, but you have to be very choosy. The valuations have not become cheap. They have cooled down, but you have to be very choosy. So apart from that, our top allocations continue to be in telecom, hospitals. We especially after the GST cut in health insurance, we are seeing further government push in hospitals, and yeah. So these are the names we are broadly allocated.
All right, understood. Thank you, Krishna, for that update. Top allocations in the telecom and hospital space. On that note, we'll let you go. It was great having you on the show today.
Thank you. Thank you.
All right, with that, it's time to take a very quick break. We'll be right back with more news and updates on the other side.